Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Datavault AI.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine buying 5 pounds of heavy industrial copper.
Okay.
But instead of figuring out how to transport it or, worrying about where to store a massive pallet of metal in some warehouse somewhere, it just sits seamlessly right there in your digital wallet.
Right next to your shares of Apple or your index funds.
Exactly. Today, we are breaking down a company that is essentially attempting to rewrite how you interact with physical and digital assets.
It's a huge undertaking.
It really is. Our mission today is to map out Datavault AI's incredibly aggressive transition from what you might call like a speculative, prove-it-to-me development stage directly into a revenue-generating growth story.
And they moved fast.
They really did. We need to figure out exactly how they pulled this off and, more importantly, analyze if their upcoming catalysts make this a viable wealth-building opportunity for you. So let's jump right into the financial reality. Because on March 19th, 2026, the entire narrative around this company seemed to just physically shift.
It absolutely did. And that shift was driven by the single strongest catalyst you can possibly have in the equity markets. Hard, undeniable financial results.
The numbers.
Yeah, exactly. On that specific date, they reported their very first profitable quarter. But it is the top-line revenue from the fourth quarter of 2025 that really grabbed the market by the collar, forced it to pay attention.
We are talking about $33.8 million in revenue.
Which, out of context, is a solid, respectable number for an emerging tech firm.
But context is everything here, right? Because that $33.8 million represents a 3,650% year-over-year growth.
Yeah.
3,650%.
Yeah.
That kind of metric is almost jarring to look at. It's like a startup suddenly flipping the switch and turning into a cash printing machine.
It is jarring. And what's fascinating here is the underlying psychology of that moment for the broader market. Reaching inaugural profitability is a massive de-risking event.
That's so.
Well, think about it from the perspective of an institutional investor. When a company is in its pure development phase, you are essentially funding its survival.
Right. The cash burn.
Exactly. Every single dollar of cash burn is heavily scrutinized. There's this constant lingering fear in the back of your mind of the company running out of runway before they even finish their product.
Yeah, the classic startup death spiral.
But the moment you prove commercial viability, the absolute moment you show that your product actually generates more cash from customers than it costs to operate, the entire valuation model completely flips.
So you shift from pricing in survival risk, which carries a heavy discount, to pricing in aggressive growth potential.
Spot on.
But I have to push back a little on this right out of the gate, because seeing a 3,650% revenue spike immediately triggers my skepticism.
It's fair.
My first thought is, okay, is this just a one-off accounting spike? Did they land one massive contract, record all the revenue in a single quarter to make the books look amazing, and now we're going to see a painful reversion to the mean? How do you actually know this is a sustainable trend that warrants a place in the long-term wealth-building strategy?
That is the exact critical question you should be asking, and frankly, it's exactly what the institutional money managers were asking that morning.
Right.
The answer to your skepticism, it actually lies in their forward guidance. Management didn't just report that massive fourth quarter and pat themselves on the back. They actively raised their 2025 revenue outlook to $40 million.
Okay, so they doubled down.
They did. By raising that forward-looking guidance, management is publicly going on the record to signal sustained recurring demand, and the market believed them.
The volume was huge that day, wasn't it?
Off the charts. If you look at the trading data during that session, the stock became one of the most active in the entire market. That kind of sustained volume isn't just retail day traders reacting to a flashy headline.
It's the heavy hitters.
Exactly. It indicates serious institutional accumulation. The smart money saw the de-risking event, they verified the forward guidance, and they started building heavy long-term positions.
Okay, so the financial foundation is suddenly there. The money is real. But you don't generate $33 million out of thin air, especially in a nascent industry. You need a highly functioning mechanism to do that.
Absolutely.
And this brings us to what they are actually doing with their technology. They have a proprietary, patented tech stack. We're talking about platforms with names like Information Data Exchange, DataScore, and DataValue. What are these platforms actually doing on a mechanical level?
So, at their core, these platforms function as a comprehensive blockchain tokenization engine. Let's break down the mechanics here.
Okay, let's hear it.
Their goal is to take a real-world physical asset, securely evaluate exactly what it is worth, and create a digital representation of it on a secure ledger so you can easily trade it. It works in a very specific sequence.
Step 1.
First, the information data exchange platform handles the highly secure transfer of the initial asset data.
Got it.
Then DataScore steps in, and this is arguably the most critical piece. DataScore handles the authentication and the complex valuation metrics to ensure the asset is priced correctly based on real-time market conditions.
So it's like the appraiser.
Exactly like an appraiser. Finally, DataValue acts as the actual ledger itself where the token lives. The fact that this entire interconnected process is heavily patented is vital for your portfolio.
Because it builds a wall around their business.
A massive one. It creates a legitimate, legally defensible technological moat in the real-world asset tokenization sector, which is, still incredibly young and fiercely competitive.
And we actually got to see that technological moat put to the ultimate test very recently. On March 31st, they announced the launch of Coppercoin, which caused the shares to immediately trade higher.
Yeah, the market loved it.
The specifics of this deal are wild. They signed a definitive agreement to mint $100 million, or potentially more, in digital copper tokens by the end of the second quarter of 2026.
It's a huge milestone.
And the defining feature, the hook here, is that each individual token is inextricably linked to exactly 5 pounds of underlying high-grade physical copper.
And if we step back and connect this to the broader economic picture, the timing of Coppercoin is absolutely not a coincidence. We are currently sitting right in the middle of a massive macro tailwind.
And when you say macro tailwind, you just mean a massive, unstoppable global economic trend that pushes a specific industry forward.
Exactly. In this case, we have a perfect storm of demand. You have the AI infrastructure boom, meaning the sheer staggering amount of new data centers being built globally to process artificial intelligence.
Which need power.
Tons of it. Those data centers require thousands of miles of copper wiring for power generation and cooling. Combine that with the broader transition to renewable energy grids and the manufacturing of electric vehicles, which use significantly more copper than gas-powered cars.
So it's coming from all sides.
It really is. This is driving what many structural analysts are calling a copper supercycle. We simply do not have enough new copper mines coming online to meet the projected global demand of an electrified, AI-driven world.
So the demand for the physical metal is entirely undeniable. That makes sense. But I keep getting hung up on the actual logistics of this.
The execution part.
Yeah. Tokenizing a purely digital asset, like a piece of software or a traditional cryptocurrency is one thing. It lives natively on the internet. But tokenizing physical copper, isn't there a massive execution hurdle here?
It's the biggest hurdle there is.
I mean, a patent is just a piece of legal paper. How does their tech actually stop a warehouse manager from loading that copper onto a truck and stealing it? You're tying a digital token floating in cyberspace directly to 5 pounds of heavy metal sitting on a pallet? How do you audit that?
It's tough.
How do you actually ensure the token holder has a legally binding claim to that exact physical asset?
You've just identified the primary make-or-break execution risk of the entire real-world asset industry. It is incredibly difficult to build a foolproof physical-to-digital bridge.
So how do they do it?
Well, here is how Datavault AI is engineering that mechanism. Think of it like a highly advanced digital coat check.
Okay.
When the physical copper arrives at a certified third-party warehouse, it doesn't just sit there. It is integrated with automated IoT Internet of Things sensors.
Oh, wow.
Yeah, these sensors continuously monitor the weight and location of that specific pallet. That real-time physical data is fed directly into their DataScore platform, which triggers automated smart contracts.
And the smart contract is just self-executing code.
Yeah. Yep. It just says, if the sensor confirms the 5 pounds of copper is in slot A, then validate the digital token. All of this is recorded on an immutable ledger.
And just to clarify for everyone listening, when you say immutable ledger, you just mean the digital receipt is written in permanent ink across thousands of computers at the exact same time.
Exactly. No single warehouse manager, and not even Datavault AI themselves, can go into the system and just white out a missing shipment or alter the records.
So the transparency is absolute.
Yes. If there is a disconnect, if a sensor goes offline or an auditor flags a discrepancy, the smart contract immediately halts the trading of that specific token until the physical asset is verified.
That's brilliant.
It's precisely why their patented tech stack is their ultimate competitive advantage. If they successfully execute this $100 million minting by the end of Q2 without a logistical failure, they definitively prove to the global financial system that their infrastructure works.
And for you as an investor, it solves a massive friction point. Because it gives your portfolio direct exposure to this massive copper supercycle without you actually having to figure out how to trade the physical metal on the commodities market.
Precisely. You don't have to worry about taking delivery of raw copper wire. You don't have to negotiate warehouse storage fees. And you don't have to deal with physical security.
You just buy the token.
You simply hold the digital token, which has deep, instant liquidity, but perfectly tracks the real-world value of the underlying scarcity. It is a completely frictionless way to participate in a highly constrained physical market.
But relying purely on copper prices is a massive vulnerability, right? I mean, if the global economy slows down and the supercycle stalls, interest in those tokens could drop. They needed something completely immune to the traditional economy.
And they found it.
They did. Less than a week before the Coppercoin announcement, on March 25th, they announced a partnership with the elite professional boxer Moses Atoma. They are officially moving into the name, image, and likeness, or NIL sports digital asset space.
Which is a complete paradigm shift from industrial commodities.
Right. It completely reframes how we should be looking at this company. I was trying to think of how to explain this shift, and it feels exactly like looking at an early e-commerce giant in the late 90s.
Oh, that's a good comparison.
You know, they started out just selling books, and everybody looked at them and thought, okay, they are a digital bookstore. But what they were actually building in the background was an unprecedented logistics and delivery network.
Right, the infrastructure.
Exactly. Once that network of warehouses and shipping routes was perfected, they realized they could put literally anything in those cardboard boxes. By moving seamlessly from industrial copper to a professional heavyweight boxer, Datavault AI is essentially proving their blockchain ecosystem is completely asset agnostic.
They aren't a copper company.
No. They are a universal tokenization logistics network.
That is a phenomenal mental model for what is happening here. And the financial implications of being truly asset agnostic are profound for your wealth building strategy. Well, it creates a unique network effect and massive structural revenue diversification. Let's look at the mechanics of the NIL space. When you tokenize a boxer like Moses Atoma, you are essentially allowing fans and investors to buy a digital stake in his future earning potential.
Wow.
His brand sponsorships, or exclusive access to his career milestones.
So it's the ultimate alternative asset, human talent and extreme fan loyalty.
Exactly. And here is why that matters for your portfolio. The sports NIL market behaves completely independently of macroeconomic commodity cycles.
That makes total sense.
Right. If global manufacturing slows down and copper prices dip, diehard boxing fans do not care. They are still going to invest in their favorite athlete's digital ecosystem.
They're completely disconnected.
Completely. By diversifying into sports, Datavault AI is creating multiple, entirely uncorrelated revenue streams, all utilizing the exact same underlying patented technology. This heavily enriches the long-term thesis because it stabilizes their revenue against global economic shocks.
Okay, so let's summarize where we are. We have explosive, verified revenue growth. We have a patented technological moat that solves the physical to digital auditing problem.
Yep.
We have a massive macro catalyst in the copper supercycle, and we have definitive proof of concept that their platform can diversify into completely uncorrelated markets like sports.
It's a strong list.
It all sounds incredibly bullish. But as an investor, whenever a setup looks this perfect, I immediately start looking for the catch.
There's always a catch.
Building this universal, Amazon-like logistics network for digital tokens and floating $100 million in Coppercoin does not come cheap. This brings us to the double-edged sword of capital and the very real bear case that you need to carefully weigh.
Yes, and the market was reminded of this financial reality very recently. On March 20th, literally right after the euphoria of their first profitable earnings report, the company filed a prospectus for a shelf offering of up to $1 billion in securities.
And this is where I really have to challenge the prevailing bullish sentiment. A $1 billion shelf offering for a company that just celebrated its first profitable quarter sounds absolutely terrifying from a shareholder perspective.
It definitely spooks people.
Doesn't this just hang over existing investors like a giant dark cloud of potential dilution? I mean, you finally get the company to cross the profitability finish line, and management's immediate reward is the threat of massive share issuance.
Yeah, the timing is rough.
And to compound that fear, we saw direct action from the analyst community. Maxim Group's Jack Vander Aarde maintained a buy rating on March 30th, but he explicitly lowered his price target from $4 down to $3. If everything is executing perfectly with Coppercoin and the sports deals, why on earth is the price target coming down?
It's a very fair critique, and it highlights the fundamental tension inherent in aggressive growth investing. Let's break down the exact math and mechanics here, starting with the analyst's price target cut.
Okay, let's hear the math.
That reduction from $4 to $3 is almost certainly a direct mathematical reaction to the dilution risk you just mentioned. When an institutional analyst builds a valuation model for a stock, they have to account for the total number of shares outstanding.
Right.
Think of the company's total value as a pizza.
Okay, I like pizza.
Right now, that pizza is cut into a set number of slices. If the company signals they might issue a massive block of millions of new shares, they aren't making the pizza any bigger right away.
They are just cutting it into way more slices.
Exactly. The value of your individual slice, your existing share, is proportionally diluted. So the analyst is essentially saying, look, the core business operations are still a fundamental buy.
But as slices are getting smaller.
Precisely. We are forced to compress the near-term target price to account for the impending valuation volatility caused by all these potential new slices of the pie.
So the threat of dilution is very real, and the smart money has already quantified it into the price. But I want to dig into the actual mechanism of a shelf offering. Because that word shelf is doing a lot of heavy lifting here. They aren't just blindly dumping $1 billion worth of stock onto the open market tomorrow morning, are they?
No, they aren't. And understanding that mechanical distinction is absolutely critical for your anxiety levels as an investor.
Okay, phew.
A shelf offering is essentially a massive corporate pre-approval. The best way to understand it is to think about a home equity line of credit, a HELOC C on your house.
Oh, okay.
When you get approved for a $100,000 HELOC C, you don't instantly borrow the money, right? And you don't instantly start paying interest on it. But the paperwork is done, the bank has signed off, and the capital is just sitting there available to you instantly if the roof caves in or if you decide to build a massive addition.
That makes a lot of sense.
A shelf offering works the exact same way for a publicly traded company. It allows them to register the securities with the regulators now, but keep them literally on the shelf to be offered quickly and efficiently at a later date, usually over a period of up to 3 years.
Okay, that makes sense.
Yeah.
It's a tool for immense financial agility. It means they aren't facing an immediate liquidity crisis or a cash crunch. If they suddenly need rapid capital to fund a massive new sports tokenization initiative next year, they don't have to spend 6 months bogged down in regulatory paperwork.
Right, they just pull the pre-approved shares off the shelf.
Exactly.
However, we do have to look at the sheer scale of that number. $1 billion. That is a gargantuan financial war chest for a company of this size.
Is massive.
It fuels a lot of logical speculation about what management's ultimate endgame strategy really is here. You do not ask regulators for $1 billion shelf offering just to keep the lights on and pay your server bills, especially when your core operations are already generating profitable cash flow.
So what's the play?
Well, there is widespread industry speculation that this massive authority could fuel major mergers and acquisitions.
Oh, that makes total sense.
Mm-hmm.
If their ultimate goal is to be the universally dominant infrastructure for all real-world assets, they might use that pre-approved capital to outright acquire specialized data auditing firms to permanently enhance their DataScore platform.
Absolutely.
Or, if they really want to control a copper supercycle, they might even acquire physical mining operations to vertically integrate their entire supply chain from the dirt to the digital wallet.
It's a very logical strategic leap, so it truly is a double-edged sword that you have to manage. Yes, the dilution risk mathematically caps the near-term upside of the stock price, which is why the target was lowered to $3.
Right.
But that exact same capital access ensures they can aggressively execute their land grab strategy and buy up competitors in the tokenization space without missing a single beat.
So, bringing this all together, what does this mean for your portfolio right now? How do we synthesize the explosive $33 million revenue growth, the massive tokenization catalysts in copper and sports, and the very real capital dilution risks into a cohesive, actionable strategy?
When we aggressively weigh all of these conflicting factors, the final investment thesis yields a bullish score of 7.5 out of 10.
Okay, 7.5.
Yeah. The fundamental turn to profitability and the validation of their tech stack is excellent, but that score is kept strictly from being a 9 or a 10 because of the billion-dollar dilution overhang. This is a classic, asymmetric risk-reward play perfectly tailored for growth-oriented investors.
So it's not a day trade.
Definitely not.
Yeah.
The target horizon here is not a quick day trade. You should view this as a swing to intermediate hold, roughly in the 3 to 6 month range.
And what exactly are the concrete milestones we are watching for in that crucial 3 to 6 month window?
You need to be watching for two major execution events. First, the physical execution of the Q2 2026 Coppercoin launch.
We need to see it work.
We need to see that $100 million minting actually hit the market successfully, proving that their digital coat check and IoT sensors work without a catastrophic logistical failure.
And the second milestone.
Second, you need to closely watch the upcoming Q1 2026 earnings report to confirm that management's raised $40 million forward revenue trajectory is actually materializing on the balance sheet.
Checking the math.
Exactly. If they hit those two specific milestones, the structural thesis is fully validated, and the dilution risk becomes a secondary concern to the explosive growth.
It is going to be an incredible timeline to watch unfold. Because when you step back from the specific daily stock charts, the ultimate success of Datavault AI might not just depend on where global copper markets go or how many elite sports stars they sign to their platform.
It's much bigger than that.
It really hinges on a much larger philosophical question. Is traditional finance truly ready to accept blockchain tokenization as the new frictionless standard? Just imagine a future where your investment portfolio seamlessly holds heavy physical commodities, high-growth software stocks, and fractional shares of human athletic talent, all sitting side by side, securely authenticated on the exact same digital ledger.
That's the vision.
That is the new reality they are trying to build. We'll be keeping a very close eye on it. Thanks for joining us, and we'll see you next time.